Hello traders, it's Tuesday, January the 29th. This is John Kicklighter, Chief Strategist for DailyFX.com, here to give you the FX market wrap-up and outlook for the coming 24 hours of trading. Now, this opening 24 hours was highlighted by the same general themes, the same general trends, as the ending of the week last week. However, we didn't have a lot of the momentum that was keeping volatility going. That is to be expected, considering that we do have major event risk through the middle of this week. We have Spanish GDP from the European side. We have the U.S. GDP and FOMC rate decision on the U.S. side. So there's a lot of event risk on the docket a little further out, and that's the kind of uncertainty that will probably keep a lot of these markets from generating new and aggressive trends. Of course, you do see lower liquidity periods during that time as people move to the sidelines awaiting that major event risk, and very oftentimes you see short-term non-lasting breakouts, so breakouts without the follow-through. So do be very cautious in these market conditions. But that being said, a lot of interesting development through the opening of the week, the first 24 hours of trading. I want to start with the euro-dollar. Doesn't seem notable. It didn't move very far, did it? In fact, you can see that on a change-over-change basis, a 4-hour chart, you really haven't seen all but a few pips of change from where we were after this really aggressive rally after the announcement of the LTRO repayments, and between now and the early Asia session on Tuesday trading. So that remarkable lack of progress contrasts very nicely to some of the other euro-based currency pairs. The euro-yen dropped back pretty sharply in the morning or in the evening of Monday session, and is trying to make a comeback in the early trading session today. We can actually see this replicated among some of the reversals from other yen crosses. But you also saw the dollar was putting some notable progress on other pairs. So looking at the Dow Jones FXCM dollar index, the equal weighting index of the dollar versus some of its major counterparts, the euro dollar, the pound dollar, the Aussie dollar, and dollar yen, you can see that we did put forth a fourth consecutive day advance through Monday's close. All right, that is quite a impressive move, and we've seen a couple of these instances of 4-day advances in the past, and they almost always come with very aggressive developments in underlying trends. And you can see it from the individual pairs. All right, so while the euro dollar moved almost nowhere on the day, it is remarkable because it contrasts to what we've seen with the pound dollar, which had a serious follow-through on that selling pressure. In fact, now, from a fundamental and technical perspective, the pound has dropped aggressively against most of its counterparts. So looking at some of its other primary counterparts, we have the pound dollar here, the euro pound. Take a look at that. That one's been incredible. All right, this is one of the most aggressive and straightforward trends to the upside from the pound dollar that I've seen since maybe since this big final uptrend back here in 2008. But that has been certainly very aggressive. We are now very near this descending trend of these series tops from 08 and 011. So notable resistance there, but still, the thing to take away from this performance is the pound's aggressive decline. The same thing is true if you look at pairs like the pound kiwi, all right, which I've been talking about. I'm actually in a small size, and it's not doing well now because it had that very aggressive rebound for the kiwi dollar seen across the board. But you can see that a very aggressive decline in the British pound. The same thing can be seen against even the pound CAD, which more recently, has had that very aggressive decline. But the takeaway is that the British pound itself has moved aggressively, and we know that aggressive moves often lead to rebalancing or correction. All right, doesn't necessarily mean the development of a new trend, but it does mean a higher probability of a return to a mean, a normal pace of trading. So with this pound dollar decline, you can see that we've, in this particular move, you can call it either from 106 that we've dropped down to 157 or 156.75, but really the entire wave happened or started up here at 161.60. So a pretty remarkable near 500 pip decline, and that doesn't even include the top of the range up here. But you can see that this now brings us to the 61.8 fib of this May low to the peak here that we had back at the very end of 2012. And that in and of itself also coincides with this rising trend of serious lows on a much larger wedge pattern that goes all the way back to 2009. So a broad technical pattern that we are now meeting. Of course, you don't want to fall in the trap of trying to pick tops and bottoms. That becomes very problematic, very troublesome. But you can look for the evidence of a turn, a shift. All right. One of the interesting things, the interesting aspects of the pound dollar is that this is a good setup if you're going to see a risk positive move. So the consistency, the broader trend for risk trends, if you look at the S&P 500, has been for a consistent advance from this standard bear for risk appetite trends. Now, my risk reward index has kind of deviated from the S&P 500's path, but if you see that the risk reward index is what catches up to the S&P 500 rather than vice versa, you're looking for a market that is going to be seeking out risk trends, and the FX market will start to seek out the undervalued risk-positive plays, and the pound dollar would fit into that category very nicely. All right. From the Eurodollar's perspective, yes, it can advance from a risk-on element, but is it at all oversold? Are you buying into value, or are you trying to squeeze out value from something that's already richly priced? I think this is more richly priced. I think that this is a pair I'd prefer to see a break to the downside and a sign of risk aversion, which would play to the U.S. dollar as a safe haven. Risk on, pound dollar to the upside. Now, another interesting risk on pair that could be played, Aussie dollar. If you expect a positive bearing on risk trends, what better pair than the most prized carry pair amongst the majors? All right, Aussie dollar, as you can see, has worked its way back down to the bottom of this wedge pattern. This wedge pattern started back in October, so it's not that mature, but 3 months is mature enough. It's also the midpoint to this broader range that we've had going back since July of last year. So a good 6-month range on this pair, and that's the midpoint that we've just tested through this past session. So a notable hold, a notable technical move there, and subsequently, if you do have a continuation of risk positive sentiment, then it can actually give a good positive carry for the Aussie dollars. That's a good risk-on movement. Now, another good risk-on movement comes from the Euro-Aussie. Right. Now, the Euro-Aussie, as you can see, has performed very much in favor of the euro itself as a fundamental pair. So if I went out, let's go daily. All right. So if I went daily, we had that very, very remarkable rise above this this descending trend line, which has given some very significant progress on this pair, and it's gone against risk trends. All right. One, you're moving against yield because you're selling off the Aussie dollar, and two, you're going towards a riskier, fundamentally riskier pair or currency in the euro. So an interesting combination. So if you are looking for a positive risk pair or going towards yield, but you don't want to go necessarily to a troubled currency like a euro, which can easily come back into trouble, take a look at the Euro-Aussie, because that works against the euro itself and works in favor of the Aussie. And this setup, surprisingly enough, looks exactly the same as a euro-yen. All right, you have a rally in the euro-yen on a bigger trend. All right, and you have this nice range floor here that could turn into a break, and that looks exactly like the Euro-Aussie on the same time frame. So you have a very similar setup, one that's risk on. So a break to the downside for Euro-Aussie would perform well under a risk on scenario where people are buying the Australian dollar for its yield, not necessarily the euro for its risk. And you have a risk aversion alternative. So if risk aversion kicks in, then the euro-yen can actually get a break to the downside and get a natural correction, because there are patterns here where we have a bullish run, correction, bullish run, correction, bullish run, and maybe a correction here. It's not confirmed until you have an actual break and technical support to find it. But we did see this is actually a 5.6% advance. I believe it's a 3% correction. And then you had approximately a 3% advance and a 3% correction. So now we're on a 5% advance from trough to peak here. Now we're going to see what happens to see if there's going to be a similar situation. But the takeaway is that a euro-yen decline and a euro-Aussie decline are on opposite ends of the fundamental spectrum, yet they have very similar technical patterns. So you have a interesting technical and fundamental situation there that provides an opportunity on both sides. Very rarely do you find these general setups. So, looking for risk appetite drives, you have a very interesting Euro Aussie to the short side. You have a very appealing Aussie dollar bounce potentially in the bottom of this congestion pattern. You have a pound dollar, which is somewhat oversold. Now, of course, on each of these opportunities, it's best not to try to pick tops and bottoms. This is not what we're trying to do. High probabilities are not picking tops and bottoms. Picking tops and bottoms are correct a fraction of the time that just following the broader trend is actually successful. So you want to follow the highest probabilities, and the highest probabilities is looking for a trend that has already developed. That means you might miss out maybe at the very ends of the reversal, but at the same time you're making a greater chunk of the trade with a greater probability on hand. So those are my positive risk bearings and sentiments, and they flesh out well when you look at the general path that something like the S&P 500, which, though it has certainly an element of being far overbought, it can still maintain, especially going into Wednesday's huge event risk. Between now and then, it's very likely that people will not commit to major risk-based trends because they don't want to take something in this lull of a trading day, looking forward to something more dramatic in this very important day with the Spanish GDP, US GDP, and FOMC rate decision. So that's the general approach, the general way that I'm taking is very short term. I'm not looking for anything medium to long term as of just yet, but I still am keeping those forecasts for the shifts in trends, especially on pairs like the yen crosses. All right, the dollar yen after that incredible 11-week run to the upside, the longest series of runs, bullish runs that we've seen from this pair going back on records to 1971 when it was freely floated. I have an ATR here, a 20-day ATR, it's a good approximation of just the volatility index for the FX market, and you can see that this has itself risen to the highest level we've seen since nearly 2 years or 3 years ago. So an incredible measure there. And you're seeing that a lot of these yen measures themselves are overbought. They're overdone. You can even look at the weekly chart of the dollar yen, and you see once again the RSI. All right, the RSI is a favorite indicator amongst many traders, and you can see that we haven't seen an RSI reading at 85, which it just recently peaked out at 85 on record. All right, first time I have on record that the RSI has gone to 85. So while you do have a long, a wide open exposure to the upside for multiple months, maybe even years, in the near term, in the very short term, it's moved too far too fast. The relative strength is just beyond what you would expect from normal conditions, even these types of trading conditions. So a high probability of a correction there, and with each additional week it just gets higher and higher. But you need to see the actual turn. You need to be convinced on a technical and a fundamental basis that the yen crosses are reversing. From the dollar yen, I think that it would fall to the same kind of situation. If you see a reversal, it would follow the same kind of lines that you would get from any of the other yen crosses, most notably risk aversion. Risk aversion, if you saw this stimulus-laden S&P 500 reverse, then you would most likely see the same type of scenario play out for the crosses, the yen crosses, because they're highly carry sensitive. So something like the euro yen, this is a 2-hour chart, seeing a reversal, not necessarily for a major trend turn, but maybe back to its trend line, all right, trend line support. The same thing can happen to the dollar yen, maybe. But the pound yen, not as actually, that one has not really left its trend line support too much, and in fact, it never really overtook the previous swing highs that we had back in earlier in January 2 weeks ago. So maybe a break to the downside here if if risk aversion actually does gain serious traction. And then of course you can see crosses like the Kiwi yen and the Aussie yen, which are far more sensitive to carry trade interest. And Aussie yen, interestingly enough, has not been able to breach 95. If these pairs actually see reversal, it might have better consistency and follow through because it is directly unwinding of carry trade, which is the primary interest on the risk side of risk reward. So the yen crosses are a constant reminder that there's a bigger interest at heart, a medium-term trend that can certainly develop if we are given the right conditions. And the best way to get these right conditions if you see volatility pick up. So comparison of FX volatility versus the equity markets volatility, you can see that FX has already been elevated. Now you're starting to see the equities version ticked up on Monday, finally getting us back above 13.5%. Still extremely low on a historical basis. But when volatility picks up, that's when you have something like the balance of risk and reward, which we see in the risk reward index, starts to really take over and can manipulate risk aversion and leverage a very serious move towards risk aversion. Now, for pairs like the yen crosses, the implications are clear. But from pairs like the euro dollar, it's even more remarkable that the deviation from the historic norm for following risk appetite will correct back in. See, the yen cross has never really left the risk on, risk off scenario. They've followed through. But something like the euro dollar has deviated substantially. And that fact alone means that realigning that fundamental factor can generate a very substantial, very hardy swing from the euro dollar. So I've actually put a data label here so you can see where we're at. Now we're at, it's actually not 78, I believe it's 72, 74. So we've overtaken this one back here in May of 2011, but we have yet very close to overtaking that lull in late January, early February. That actually notably set a reversal point. But each of these times, that we've seen a very notable spike in negative correlation between the euro-dollar and risk trends. When it has changed, we've seen that it's been driven by risk trends because risk trends reinvigorate these markets. They retain control, and it's generally to a very substantial market movement. So you had this reversal, you had this reversal and strong follow through, you had this reversal. You have a notable swing here to the downside. You have a notable swing here to the downside. Continuation, very aggressive move. All right, so now we're at the same kind of situation. Yet we have not seen that acceleration or that reversal. Because while you have that jump above 134, it does not come because of a reconnection to a more aggressive dominant risk theme. So keeping that in mind. But I do want to keep you within the picture of the bigger fundamental schematic. All right, I said that there's major event risk on the docket that can lead to short to medium term trends, depending on what happens. Although I'm not really putting out too much expectation for the U.S. GDP and the FOMC rate decision. We'll talk more about those tomorrow. But you got to be very careful about the bigger themes, including the currency war status. All right, here's the S&P 500 versus total central bank balance sheet size. All right, and this includes the Fed, the ECB, the Bank of England, the Bank of Japan, and the People's Bank of China. So I got the biggest central banks, and I've aggregated their efforts, their stimulus, into one. Now, despite all the things that you've heard recently, all right, this is what the balance sheet, the total balance sheet looks like now. And as you can see, we've actually not grown the balance sheet meaningfully for the past 4 or 5 months. All right, so looking back in that last thrust through September of last year, since then, even though we have a Fed stimulus effort, $85 billion per month, we're starting to see a rounding of the stimulus programs. All right, and that rounding, as we've seen in the past, has actually led to some significant downturns in the S&P 500 when the markets realized that they don't have that fundamental factor. Because if I were looking at risk reward, all right, and that's what I did here. You're looking at the fundamental elements for return and for volatility or risk. And as you can see, yes, it's helped stabilize the risk with the massive increase in stimulus that started back here in the height of the crisis back in 2008. But since then, you've not really had a solid foundation for investment. It's been a lot of contribution through stimulus programs. And this is an overall measure of risk trends. This is whether risk trends in general can be elevated and maintained. From the perspective of the most risk-sensitive of assets. Specifically, here you have the S&P 500. But when we take it from a case-by-case basis, that's when we start to talk about the performance of individual balance sheets. So, who is growing more rapidly? The Bank of Japan or the Fed? All right, and that actual measurement, we actually have the Bank of Japan that's growing faster, the Fed that's growing faster than the Bank of Japan, even though the Bank of Japan has promised huge stimulus programs. And then you have something like the ECB versus the Fed. All right, on that perspective, you actually have the ECB withdrawing stimulus. All right, and the Fed falling well behind with the continued expansion. So you actually have a overall stimulus effort, but you also have a competitive effort, and that's the currency wars that people have been talking about. So we keep a very close eye on these bigger themes and how they impact broader risk trends, which we seem to ignore more so recently because it just really hasn't taken traction. And we also see how it works in terms of competitive devaluation of currencies. So that's why we keep talking about the dollar-yen in terms of balance sheets. That's why I keep talking about the euro-dollar in terms of balance sheets. And of course, we can always try to get away from risk-based trends, and volatility is actually pretty high for those non-risk currencies. The euro-pound is non-risk, and it really does show a lot of volatility through the fundamental factors that we've had. Recently, through the past session at least, the the New Zealand dollar's volatility has shown some exceptional movement on pairs like Aussie Q, which are normally very quiet and steadfast, but you can see the volatility there. Interesting pattern on Aussie CAD. You can see a candle within a candle within a candle within a candle right now. That tells me you're probably going to have a breakout, whether it has followed through or not. Likely depends on what the catalyst is for that breakout, but very remarkable setup. And of course, you can always look outside of the FX market to get a sense of what's going on. If people are looking to get away from FX and there's capital leaving it, or if it's pretty stable and people will be picking the strong currency versus weak currency. We can do this from getting a third-party perspective from gold. And as you can see, that decline in gold has actually held, yet you're not making much more progress for the decline. In fact, you can see if I pull the fib off of this, that we are now below the midpoint on that range, and we're actually now just bouncing off that 61.8 fib. So just good to get perspective, especially if you're trading in something like the FX market, but you want to see something that measures the differences in the FX value versus whether people are actually taking capital out of FX. All right. So a lot of interesting setups, but the best thing to do right now is to look at those relative performances, those relative values, and you can do that between something like a euro dollar, which could be a risk aversion, or a pound dollar or an Aussie dollar, which can be a risk on. So you can find these different opportunities, and you can find which one suits the fundamentals that do develop going forward, and you have opportunities on both sides. So keep an eye on these markets. I'm not expecting huge changes through the coming 24 hours because we are waiting for that major event risk on Wednesday. Good luck trading out there, guys, and I'll talk to you once again tomorrow.